Who knows? High-yield bonds may help to protect you against stock market losses. If the stock market is down, when you look at a portfolio of bonds, you'll find that they are down too. Welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge. Today's video will teach you the 15 best high-yield and low-risk investments for 2023. Most of us want to invest in high-yield investments for an obvious reason, so we can earn money. But it's a difficult endeavor. Finding high-income assets that aren't yield traps requires a lot of research, and it can be quite risky if you don't know what you're doing. No wonder high yield has been on the rise. Want to get rich? Buy high-yield bonds. Why should one invest? The best high-yield and low-risk investments can help you fund your retirement, give you an additional source of passive income, or even pull you out of a tight spot financially. Passive income helps you reach your financial goals and increase your purchasing power over time. This is the most critical benefit that comes from a high-return investment. It's also possible that you just recently sold your house or came into some money. Putting your money to work for you is a prudent choice that should be taken. There's a wide variety of ways to invest one's money, ranging from choices with low levels of risk, such as certificates of deposit and money market accounts, to choices with a medium level of risk, such as corporate bonds, and even choices with higher level of risk, such as a stock index fund. This is excellent news since it indicates that you can locate investments that cater to your risk profile and a range of returns to choose from. It also means that you can mix low-risk investments to produce a balanced and diversified portfolio, resulting in a safer portfolio. Number 15. High-yield savings accounts. A high-yield savings account, also known as a HYSA, is quite similar to a regular savings account. However, it offers a higher interest rate. Your money is safe in these high-yield savings accounts because they are protected by the Federal Deposit Insurance Corporation, or the FDIC, which means that even if the bank fails, you won't lose access to your money. The returns on a high-yield savings account are typically on the lower end of the return spectrum, sitting at about 3 to 3.5%. But you should always search around for the best rates. Suppose you are willing to switch banks and credit unions frequently to take advantage of minute differences in interest rates. In that case, you could open an account with a financial institution currently offering the highest rate and then switch if you discover a different financial institution offering a better rate. If you would rather have everything predetermined and not have to worry about it again, choose a bank that has a more extended history and is aggressive about rate modifications on your behalf. Low-risk investments are a safe deposit bet when markets are choppy. What type of low-risk investments should you include in your portfolio? If you invest, it's your job to find the right balance. Leave a comment below, like, and subscribe to the video if you enjoy it. Number 14. Series 1 bonds. This bond contributes toward the building of a protection fund against inflation. It begins with a base interest rate and then adds a component based on the inflation rate. The end effect is that the dividend will increase in proportion to any increase in inflation. But the converse is also true. Interest rates will decrease if inflation goes down. Every 6 months, the adjustment for inflation is recalculated. These bonds are another alternative worth considering for investors who want to shield the value of their investments from the effects of inflation. These safe investments with high return bonds, along with other forms of government-issued debt, are regarded as being among the least vulnerable to the possibility of default anywhere in the world. Series 1 bonds are entitled to accrue interest at a rate tied to the inflation rate in effect at the time of the bond's issuance. Number 13. Treasury bills and Treasury bonds. Your first and best alternative is to invest in government bonds, which provide a yield ranging from 2.46% for 1 month to 3.58% for 30 years. These bonds do not include a significant amount of additional risk. Because of this stability, however, bonds may have yields lower than the rates you could earn from bonds in which it was less probable that the debt would be paid back, such as with corporate bonds. Now, the complete confidence and credit of the United States government stand behind any bonds that the United States Treasury issues. The United States has a long heritage of honoring its financial obligations. You require access to your cash before the debt is mature. This makes government debt more dependable and easier to buy and sell on secondary markets. Number 12. Real Estate Investment Trusts, or REITs. To provide high dividend yields to investors, the law mandates that REITs pay out at least 90% of the taxable income they generate as dividends to their shareholders. Putting money into a real estate investment trust can be an excellent way to diversify your portfolio and gain exposure to the real estate industry without making direct property purchases. Investors who need to sell their shares fast may find that publicly traded REITs are often more liquid than private ones, and are a preferable option for them. Because some REITs concentrate on particular categories of real estate or parts of the country, you'll need to select an option that is congruent with your objectives for your portfolio. Number 11. Money market funds. It's more common for brokerage firms to be the ones to sell them, but some banks may also sell them. Nonetheless, it's essential to remember that the federal government does not insure these investments. Also, in contrast to certificates of deposit, money market funds are liquid, which means that you have unlimited access to the money you invest in them at any time. A money market fund, in the same way that index funds are baskets containing a variety of stocks and bonds and other assets, is a basket containing CDs, bonds, and other low-risk assets within a single fund. Because money market funds only invest in the safest securities such as short-term, cash-like investments that carry very little to no risk, the possibility of incurring a loss on your investment is extremely low, although it is theoretically possible. Number 10. S&P 500 Index Funds. An S&P 500 Index Fund is a good choice for any stock investor who wants a diversified investment and can stay invested for at least 3 to 5 years. The fund comprises about 500 of the biggest companies in the United States. This means it includes many of the most successful companies in the world. If you want higher returns than traditional banking products or bonds, an S&P 500 index fund is a good alternative, even though it is riskier. If you want higher returns than traditional banking products or bonds, an S&P 500 index fund is a good alternative, even if it is a little riskier. An S&P 500 index fund is an excellent choice for first-time investors because it gives them a wide range of stocks. An S&P 500 fund is a low-risk way to invest in stocks because it is made up of the best companies on the market and has a lot of different types of stocks. Number 9. Corporate bonds. High-grade corporate debt could be a good choice if you're willing to take on a little more risk in exchange for higher returns. These bonds, which well-known and successful companies issue, usually offer safe investments with higher returns than treasuries or money market accounts. Even though investment-grade bonds are usually considered relatively safe investments, they are still not as safe as money in the bank account. That's why it's essential to focus on debts issued by companies with high ratings that will most likely pay you back. Less well-known companies may have higher interest rates, but you will likely lose money with them. Since the interest rates on bonds are usually fixed for a particular time, your money won't earn a higher rate. If interest rates have gone up overall, you may have to sell your bond for less than what you paid for them if you need to. If you keep your bonds until they mature, you will get back their face value plus whatever interest you've earned. Number 8. NASDAQ 100 Index Fund. It is well suited for investors who are prepared to tolerate a reasonable amount of volatility in exchange for the possibility of substantial growth. If you have a long-term investing perspective, a NASDAQ 100 index fund can be one of the investments with the best possible yields for you to choose from. Instead of investing in a single stock, they expose you to a whole basket of equities that mirror a particular index, such as the NASDAQ. It gives access to the most successful firms today, such as Apple, Microsoft, and even Facebook. You can ignore the short-term fluctuations and have confidence that your investment will produce profitable results over the medium to long term. Number 7. Money market accounts. Money market accounts are like CDs or savings accounts in that they are federally insured bank accounts. However, they give you more ways to take money out of the account or spend it immediately. They give returns that are about the same as high-yield savings accounts. People who want a low-risk investment that lets them get cash when needed should get a money market account. Even though a money market account won't give you the best returns, it will protect your primary investment. Like a high-yield savings account, they are an excellent way to save money quickly for things like buying a car or building up an emergency fund. Number 6. Dividend stock funds. Dividend stock funds are an excellent option for almost every kind of stock investor. People who need money and can keep their money invested for a long time may be interested in these. Individual stock purchases are better for intermediate and advanced investors, whether the stocks pay dividends or not, but you can lower your risk by buying a group through a stock fund. Make sure you invest in companies with a good record of raising dividends. Don't just choose the ones with the highest current yield. With a dividend stock, your investments will grow in value over time and you'll get money immediately. Number 5. Fixed annuities. Blueprint Income, a marketplace for fixed annuities, claims that the 10-year fixed annuity rates are around 4.75%. Remember though that insurance companies with lower reputations and higher interest rates are more likely not to pay. Fixed annuities are annuity contracts that lets investors pay a lump sum upfront in exchange for a series of payments over time. Like with CDs, you may have to pay fees if you need your money before the fixed annuity matures. You will get a portion of your money each month without paying a fee. Number 4. Preferred stocks. Preferred stocks, like bonds, pay dividends on a set schedule. Preferred stock issuers, however, may, in rare cases, temporarily halt dividend payments, albeit they will often be required to catch up on any arrears. Compared to ordinary stocks, which are more like high-quality bonds, preferred stocks are riskier and more like junk bonds. Still, if the market crashes or interest rates increase, their value might shift significantly. Preferred stocks, like common stocks, usually trade on a stock exchange and should be researched thoroughly before purchase. Preferred shares are hybrid securities since holders get dividends later than bondholders but earlier than stockholders. Number 3. Index funds. An index fund is a basket of securities that track that index. Rather than purchasing a single share of stock, you can use an index fund to invest in dozens, hundreds, or even thousands of different firms at once, all of which are held by the fund itself. Index funds attempt to provide returns comparable to those of the underlying index. Since 1926, the S&P 500 index, for instance, has generated yearly average returns ranging from 10 to 11%. If you're looking for investments with low risk and high returns and have at least 10 years until you retire, purchasing and holding on to an index fund for a long haul is a fantastic alternative for investing for the long run. Number 2. Value stock funds. Value stock funds are suitable for investors who don't mind the risk of buying stocks. Stock fund investors also need a longer-term investment plan, at least 3 to 5 years, to ride out any bumps in the market. When the prices of stocks go up, as they sometimes do, many investors wonder where they can put their money. Value stock funds are usually safer than other stock funds because they are cheaper. But they are still made up of stocks, so they will change a lot more than the safer investments like short-term bonds. Many value stock funds also pay dividends, which is why many investors like them. Number 1. Short-term government bond funds. In terms of risk, these government bonds are ideal. Investors new to the market and those seeking a steady income stream may also find these products a good fit. Investors who avoid taking chances may do well with government bond ETFs. Funds investing in short-term government bonds are similar to certificates of deposits. Funds investing in short-term government bonds are similar to certificates of deposit because they don't put you at risk when interest rates rise like they did in 2022. Rate hikes won't affect short-term bonds much either. Those funds will gradually begin to pay more interest as the market's rates climb. Existing bond prices fall when the interest rates rise, and they rise when the interest rates fall. To make a good choice, you'll need to know the pros and the cons of each investment option and how they fit into your overall financial plan. Even when interest rates are low, money market funds, annuities, and government and high-grade corporate debt are some of the best low-risk and high-yield ways to grow your money. Diversifying your investments over time is always one of the safest ways to invest. Still, these less risky investments can significantly add to a well-rounded portfolio, especially when it's volatile. So that's all for today's video. If you liked this video, then hit that like button and ring that bell button so you don't miss anything else. We'll have another video for you soon, but until then, take care.